those numbers into our analysis.
Got it. Thank you, James. Thanks, Robert.
Thanks.
Our next question comes from Greg Lewis with BTIG.
Hey, thank you, and good day, everybody. I guess my first question is around, there was a lot of news and reports about refinery closures, really ongoing throughout the pandemic, whether it was in Australia, parts of Europe. A lot of refinery closures happened, and that was expected to create, dislocations, ton miles. Is it possible, or how should we think about, just given the slow recovery, in some of these parts of the world? I guess what I'm wondering is, has the full benefit of these refinery closures been realized, do we think, across, global product tanker, seaborne ton mile demand?
Not yet. Part of it, yes, but when you draw 181 million barrels of global gasoline and distillate inventories, everything's a little bit muted, and then you factor in that just overall demand is slightly below pre-COVID levels. So I think we've certainly seen it when we look at how much volume's gone to Australia. But when you start, and we've probably seen some of it with U.S. East Coast imports after the closure of the Canadian refinery. But I think we'll really start to see the impact as demand kind of gets back to pre-COVID levels, and it'll be essentially a multiplier to that.
Okay, great. And then just one more for me around the, congrats on the vessel sales, previously announced. One of the questions we always get is around the depth of the, the S&P market, and really, I think I'd be curious to hear, beyond the actual buyers, how competitive was that process, and any way to quantify how much interest there were from the broader industry for the vessels that were eventually sold?
I'll take that, Greg. The competitive process was pretty vast, in the sense that, as Robert alluded to just a few minutes ago on this call, we were vocal about the fact that we were going to sell ships, and this has created by itself a competitive process with all the interested parties coming in. There were pockets of buyers interested in MRs, LR2s, one or two on the Handys, and more than we expected on the LR1s. The reason we chose to do the transaction we did, it's because it was a clean transaction with a natural buyer that had appetite for that specific fleet, being a market leader in the LR1 segment, which appreciated the design features of our LR1 fleet, being modern, eco, wide beam, and all of the features that they didn't have in their fleet themselves. So when we started negotiating with AFMIA, it became apparent that it was a good fit for both companies, and we enjoy a good relationship and a good working relationship with them, and decided that that was going to be our main transaction, fairly early in the process, once we saw that we could have executed on that.
Okay. Thank you, Emmanuel. Have a great day, everybody.
Thank you.
Our next question comes from Ken Hoexter with Bank of America.
Hey, good morning and good afternoon. So looks like on the selling of vessels, you mentioned you get a few months runway of cash. You get through some of the repayments. Rates here are starting off a bit weaker than I guess you would have expected. Emmanuel, you were more sanguine to start the call. I know Robert, you're super uber bullish. I've been on these calls for years. I don't think you've never not been uber bullish. So what is getting you that bullish here? Is it the setup of lower inventories? It doesn't seem to have monetized for years, right? James has been talking about the drawdown of inventories, the setup of low fleet, low order book. So what needs to happen here in order to start seeing this to come to reality in terms of the rates and, moving above cash cost and starting to not worry about the refinancing and debt pay down?
I'll start, Ken.
Go on, Emmanuel.
No, I was just saying that I think James mentioned this on a few minutes ago on this call. I think that mobility is affecting demand, product tanker demand, and that is the main catalyst on which we will be seeing a recovery. I agree with what James said a few minutes ago. Mobility is the one that we are the main catalyst we're waiting for. Having said that, all the fundamentals, and I think you would agree with us, are pointing in the right direction. So it's on the demand front, things are looking okay. On the supply front, things are looking okay. On the inventory side, things are looking okay. So all the fundamentals are there. Mobility needs to kick in for the market to rip.
I think also, Ken, I think we should remember that, why, let's say, I'm uber bullish is in your words, I think that's a great word or a great phrase, is that, 2 years ago, at the beginning of 2021, the stock was over $40. Rates were really moving strongly across every sector of the product market. And what James is indicating is we're going to get a return to that demand level and, in fact, higher in terms of ton miles, because we expect demand headline to be higher and we expect these refinery changes to increase the ton mile position. But supply itself, partly because of regulation, partly because of a lack of order book, and partly because of aging and scrapping, it's more or less going to be the same, not much different. So therefore, we kind of know where that market is going to, what's going to happen at that point. We know that in this dull market that we have, with all the inventory draws against us, all the demand headwinds, that the rates are what they are that we put out today. And we have seen what that market is likely to be. And on top of that, inflation and yard tightness at the moment, and the lack of ability to order ships, and the fact that yard prices have gone up since that period 2 years ago, your actual asset values are higher than where they were 2 years ago too. So that, I think, is a very strong reason to be uber bullish, as you put it.
Yeah. It's just the setup, right? It always seems to be there. We just need, I guess, the mobility.
Yeah, but I don't think anybody predicted the COVID in January 2021, right?
So just a minor, thanks, Robert and Emmanuel. A minor, I guess, balance sheet question, if I can, Brian. Accounts payable seem to be going up significantly. Accounts receivable, I think it only minorly changed. Is there any change is that seasonal? Is there something to be highlight on the balance sheet?
Just timing differences, Ken. Nothing there. You said our liquidity goes for a few months. It goes up for more than a few months. If we look at it at the lowest rates as a company we ever had, of 10,100 in Q3 of 2020, we look at those rates compared to our break-evens. We get 8 months of time. If we look at it, what we're currently doing, we get almost 17 and a half months. So it's a little bit more than a few months. I know that's just a phrase you threw out, but I just want to make it clear to everybody on that.
Okay. Yeah. No, I was commenting from what you guys, I thought you guys had said when you did the vessel sales, it put us out a couple months on cash flows.